Hello, everyone, and welcome back to Crypto's News. It's me, Omar Bam, aka Crypto, and it's a real pleasure to be back here with you, telling you, well, filling in with you what is going on in crypto. So, as you can probably see, the prices are somewhat tapered right now. We have Bitcoin down about 5% over the last 7 days. You have Ethereum down 9% over the last 7 days. Ethereum's down 2.2% over the last 24 hours, still down quite a bit, around $1,486. And you have Bitcoin down 0.5%, just south of basically 22,000 bucks. Anticipating the prices that are going to be coming up, I think what could be doing moves to that has to do with, I guess what some of the commentators out there are saying is that it has to do with the CPI, the Consumer Price Index, basically a tell of inflation. And that is something that the Federal Reserve looks at. If inflation is higher, it's expected that they'll continue to raise rates at more aggressive levels, which would make it more difficult for folks to take out loans, for businesses to service those loans, yada, yada, which could impact prices of different assets, including cryptocurrencies. So basically, inflation high would not be good for prices. Inflation low, better for prices. It looks like they're going to be changing how they look at that expenditure. Previously, they looked at prices 2 years ago and then took out an average of that for the index. That's actually going to be changing tomorrow to the last year's prices. So going back only 1 year, this was covered on Real Vision. You can check it out on their Twitter page, and you will see that this is something that makes it look basically like inflation is not as bad as it is, since prices were lower 2 years ago, and it would make it look at today's prices like prices have climbed by a higher percentage or a higher index, which would mean that they would have to hike more. So by going back only 1 year when prices were higher than 2 years ago, it makes it look like inflation is not as bad as it is, and it opens the door for the Federal Reserve. For the Federal Reserve to basically hike at not such a high level, and maybe even open the door to them reversing course and doing more stimulus of money. So this is a way basically for them to fudge the numbers and make things look better than they are, which would be good again for risk assets. So I actually think that this might be a buying opportunity. We're still getting these sorts of discounts, and some of these discounts came out because of the news related to Kraken and their staking as a service business model, whereby they allow for you to stake different crypto assets through Kraken and that cryptocurrency exchange, and users basically see number go up. And the Securities and Exchange Commission did not like this. They settled with Kraken for a $30 million fine of disgorgement, and that Kraken would no longer offer these staking solutions to customers in the United States. They will offer it overseas, as we covered last week. But this was seen as a big attack on staking through centralized providers, if not the beginning of staking itself from the Securities and Exchange Commission. So that doesn't look like it's going to be completely the case, because we do have folks out there, namely Coinbase, who are not willing to just concede here and say that what they offer as well, similar to Kraken, is staking. Through staking is a security, which is what the Securities and Exchange Commission is in a nutshell assuming here, saying that this kind of model is a security. And Coinbase denied this. You had Paul Grewal, the legal compliance chief basically at Coinbase, and he put out an article talking about how Coinbase does not think that these services constitute securities. Therefore, they're not going to be changing, and they're willing to go to court to battle this. They're not just going to settle, which I think is really good, because as they said, getting regulation right is extremely important for the future, and for how these things are really understood. These new models, these new security, these non-securities that are just really a protocol and technology, that it's not just one central company that is the manager of this and allowing for users to be giving them assets in exchange for some sort of investment. That's not how this works, based on this old 1946 court decision that had led to the Howey test, which determines which is what is a security or not. So namely, return on investment. People who park their assets through staking, even on Coinbase, are not expecting like some sort of return on investment necessarily, because there's no investment. They're not giving up one asset for some sort of other financial incentive. They're not giving up money. They have full possession of it at all times through something like staking, where they can stake and unstake. Of course, this is with Ethereum specifically, pending a future upgrade for the network. But again, that's not something that Coinbase itself or any of these exchanges have a direct say in. On what the network decides for itself and what the protocol does. To allow for the unstaking is simply based on what direction Ethereum, the protocol, takes in the future, based on, of course, many different entities. It's a decentralized network. It's not like Vitalik just can decide what goes on, although of course he has some sort of influence on what others can do, but it's not his say at all. We also have common enterprise. So there is not some sort of investment for through some sort of common enterprise, as the Howey test would determine. This is something whereby users don't go through like one company to invest in some sort of a future vision or anything. No, users pool their capital with other decentralized common users of the network. That's how staking works. They put up their Ether is put up, for example, in 32 ETH buckets by many individuals to get a chance to validate the network and earn a reward for these services, which ties into the other aspects of the Howey test. An expectation of return. There should be no expectation of a return here with the Howey test, because really what's going on here, the returns that are generated are more like fees for a service. It's more like fees that are paid for validating the network. It's not an investment. The network pays you for doing work, work that is actually better than, for example, proof of work, a different way of validating transactions that Bitcoin uses and that Ethereum moved away from, which could be a little bit worse for the environment. Although you do still have to buy a computer, and you might not have to use as much computing power, which could be putting more of a strain on energy, but you still have to buy the hardware and set up the software in order to be able to validate. And that is exactly what a company like Coinbase does, is that they do IT services, as this blog post by Paul says. They basically do the work of running these computers and the software for individuals. It's not an investment through Coinbase or anything like that. So I think that Coinbase is ready to put up this fight, and this is good for shaping the future of regulation in the United States. And to go even further with that, the CEO, Brian Armstrong of Coinbase, put out a tweet today that he was in Washington, D.C., basically talking to the behind-the-scenes drafters of legislation for crypto regulation in the future. And he had some extra time, an extra slot. He was trying to get into some Dirksen Senate building and asked if anyone basically could help him get access to that. Said he was at this location, and then he put up a picture with some of the legislators. And so I think he's helping to shape things better for United States citizens, at least, so that more of this activity does not move offshore, and to give more and more people opportunity to be able to do something like staking, which is important for the decentralization of the network and for the health of the network, and so on. So really cool to see that they're not just going to concede here in this fight, and they're going to be willing to go forward with it. In other news today that you're going to want to know about, Paxos. So this is something I didn't really get to cover very much. Paxos issues stablecoins. This company, they were previously cleared by the NYDFS. They had a BIT license. So like in New York, they're allowed to operate by the New York Department of Financial Services. However, they have had to stop printing or issuing stable coins on behalf of an order from the New York Department of Financial Services. It started to come out that Binance Coin, Binance USD, which is one of the stable coins that they issue, besides their own Paxos stable coin, that this one might not be backed one for one with US dollars reserve assets. And it's coming out today that this was based on some sort of leak from a rival company. So Circle, that makes USDC. It turns out maybe in May 2022, according to Bloomberg, they said to the New York Department of Financial Services, hey, by the way, these guys are not playing by the rules. They don't have one-for-one assets. And that sparked this investigation that has led to this situation where Paxos said they're going to stop issuing Binance USD stablecoin because of this order from NYDFS. And we're also hearing that the SEC is thinking that maybe these are securities, actually, what Paxos is issuing. And they put out a Wells notice to Paxos, a Wells notice saying that there is possible future enforcement action that is going to be coming at them. Paxos did say that what they're doing is not a security, that these are segregated assets that are not intermingled. They are backed one for one. So it'll be interesting to see how this goes forward here. Yeah, I guess it could. I think it's going to be a battle that's going to be playing out for some time. But this kind of situation with attacking towards stable coins, attacking towards staking providers and so on is something that's putting some of this pressure downward on the price. But things are continuing to look good for me because I look at the 50-day moving average on a daily versus the 200-day moving average. It's turned positive. You look at the relative strength index for Bitcoin, Ethereum, that has finally come down from overheated levels where we had jumped up so much in price. We did want to see that come down. So I think for me, at least, this seems more like buying opportunities, and that things are still looking quite good here. And it's good to see that there's some courage on behalf of some of the service providers out here that are just not willing to bend completely to the government agencies that are trying to regulate by enforcement. Anyway, let me know what you guys think about any of the news that's going on, what I missed. I mean, there's plenty more out there. Not to a great degree. I think I covered some of the major ones. Like another one is that the Grayscale Investment Trust has widened to the deepest discount since like November of last year. It's down to 47% discount to net asset value, where you had the record basically being negative 49% discount. But anyway, let me know what's important to you, and I'll look forward to reading your comments down below. Take care. Thanks so much for the support and love, guys, and I'll see you next time. Peace.